So welcome to the Assurance Elective course. So for the Assurance Elective exam, as I'm sure you guys probably know, it's really 1/3 objective format questions and 2/3 case writing. So there's going to be 2 cases, 2 multis, which will have assurance for about 50 to 70%, and then probably 1 or 2 other competencies, but not specific. It could be any, probably financial accounting. And that's going to be, so it's going to be 2 cases, but there could be something else thrown in there. And then the remainder will be the objective format questions. So the case writing obviously is a very important piece, which is why we spend 3 out of the 5 classes on this course on the case side. Okay. Does anyone have any questions or anything on the actual course itself or the actual exam before we start? Everyone's good? Okay. What I'm going to be doing tonight, I'll tell you the 2 technical evenings. We're going to be covering really 4 topics in total. Tonight is actually topic number 1. It's a really big one, and it eats up the whole night. And that is what you see in front of you, which is audit strategy and planning. That's what I'm going to be covering tonight. I'll finish that tonight. And then the next session, we're going to cover 3 topics, miscellaneous topics, which includes a whole hodgepodge of miscellaneous topics, reporting, which is a big one, and we'll end with professional ethics and legal liability. And that I don't need that much time for, maybe 20 minutes, 30 minutes. Okay, so it's really 4 topics in total, but it's not divided evenly because this one happens to be a very large one. Now, a couple of introductory comments for assurance. I am going to be going quickly on a lot of the technical stuff. We record all of these sessions. You guys can watch the sessions as much as you want. If it's too quick or anything like that, then don't worry about it. Just rewatch the part, okay? Rewatch the part that you think is too quick. I do not read off all of the technical points. It would take me forever. I try to highlight what I think is important and that I think could be tested. That is my whole goal here, okay? On certain things I want to point out, other things to me are just simple. You guys can read on your own. I'm not trying to just read off the notes. Obviously, you don't need me to read off the notes, okay? That's not the purpose of the session or of the course. I will first get through a bunch of the technical, and then I'll get you guys into the multiple choice questions. Does anyone have any questions before we begin? Any comments or anything before we start? Everyone good? Okay, so this is already nice and old, but I mean, I don't know, the whole auditing was revised. We're going back now 7, 8 years when we were introduced into all the international standards. So it's not exactly the same as financial accounting where you have different rules for public and different rules for private companies, ASPE and IFRS. When it comes to auditing, we really have one handbook, but they're really made up of 2 things. They're made up of the Canadian auditing standards, which really are the CASs, kind of the international standards we adopted, and they're made up of the old standards we retained. And if you want to know if something is an old standard or a newer standard that we adopted internationally, just look at the section number. A 4-number section number is an old standard we retained, and a CAS is a new standard. Okay, this is just a table of contents. I don't really think this is all that useful. Okay, it just lists out all the sections and stuff. People, this is an open book exam, so no, you do not have to know section numbers. I'm always asked that question. All right, let me start. Let me go through. Okay, the beginning part goes very quickly. And again, if I don't really have anything to add, or I think that's particularly important, I'm just going to kind of whip through it. Okay, starting with audit objectives and principles, I guess the key word that you guys should just kind of clue into is reasonable assurance. Keep in mind, we do not obtain complete assurance, okay? We obtain reasonable assurance that the statements are free from material misstatement. All right, and this is obvious, okay, degree of confidence, okay, fine, all right. There are about 5 different principles that are kind of important that the handbook lists that are very, I don't know, these seem to be more important principles within the ethical rules, I don't know, than the others. I'm not sure why, but these things kind of win, Okay, these 5 seem to win. Ethical requirements for independence, and I don't know. So you can just kind of look at that. I don't really have anything to add on that. Everybody knows professional skepticism we have to have, professional judgment, okay, fine, all basic stuff. Management is charged with governance, so just keep in mind, it's not only the auditor that has a responsibility. Management also has a responsibility. We say it, we won't see that tonight, we'll see it next class. We say it in the audit report, okay, that management has a responsibility, not just the auditor. I try at the end of every section to give you a little thing that says watch out or areas to watch out for in multiple choice questions. I don't cover these in class once again because I can't really add any value to these. But these are good for when you guys are studying on your own. At the end of each section, have a look and see what I'm pointing out as things I think are important. Okay, the composition of CAS is also not very important. Like I'm saying, don't worry, I'll spend more time and stuff I think is more important down the road. But at the moment, this stuff is easy stuff. Okay, this is the composition of CAS is really nothing important. Consider the entire, okay, consider the entire text. Okay, fine. Don't assume that everything is relevant. You only have to comply with CASs that are relevant. Who said they're all relevant? We always try and limit our responsibility. All right, general planning decisions. Can anybody tell me where we identify the real client? You know where we identify the real client? Okay, anyone know that? No? All right, I'll give you the right answer and I'll give you some wrong answers. The right answer is who we address the audit report to. That is really our product. So ultimately, who we address the audit report, that is our real client. Some wrong answers. Those who pay us, they may be the real client, but they don't have to be. The users, they're not necessarily the real client. They're important, extremely important, but they may not be the real client. Ultimately, our product is the audit report, assuming it's an audit, or generally a review engagement report if it's a review. And who we address that report to is ultimately who's going to be our real client. Okay, terms of engagement, that is important. We'll come back to it. Okay, planning an audit, preliminary engagement activities, okay, fine, nothing here. The audit develops an audit plan, overall strategy, again, very easy, initial engagement, what you're supposed to do, fine. This was a CAS they added about 7 or 8 years ago, initial auditing standards, but it was so obvious. It's like everybody did this. You know, sometimes everybody does something in real life, and then what they do is the handbook decides, okay, let's put it into the handbook. They kind of formalize the practice that has developed. So this is an example. What are initial auditing standards? I mean, look at this stuff. It's so obvious. Who's not going to read the most recent financial statements, okay, when you're first doing an audit? Who's not going to bring the balances forward properly? Okay, so it's really easy stuff. Okay, assessing the risks of misstatements. Okay, fine. Again, nothing special here. Now, there is an important term called risk assessment procedures. That really is a defined term in the handbook. Okay, what is risk assessment procedures? That's going to come up. I'm just pointing it out now. The definition you see here, these 3 points, that's only in the context of the entity and its environment, okay, of what you're supposed to do. So there's different risk assessment procedures you would do in different situations. Now, there's 4 components to internal controls. Just be clued into the 4 different components. Number 1 we have is a control environment. Everyone should know that. That's not weird. We even use the term number 2, risk assessment process, within the internal control process. Some people think it only applies to substantive testing. It's not true. It also applies to internal controls. Number 3 is the information systems, the business processes This is basically getting into, number 3 is really getting into your typical internal controls, your segregation of duties, your, I don't know, custody of assets. This is getting into all your typical internal controls, control activities, authorization, physical controls, segregation of duties. This has been around forever. Just clue in and make sure you know the difference between general controls and application controls when you deal with IT. That is still in the handbook. It's been around for so many years. Just make sure you know the whatchamacallit, what each one is. Stuff like this is very easy to come up in a multiple choice question. And the last one of the 4 elements of internal controls is monitoring of controls. Okay. Now, people, again, I'll slow down a few minutes, but let me just go a little more and stop me if you have any questions. The basic general audit approach. So, either we do it, one sec actually, sorry, before I show you that. Either we do it at the financial statement level or at the assertion level. We'll talk about the difference in a minute. The audit approach has not changed in years. Even when we adopted the international standard, it made no difference. Either we do a primarily substantive approach, or we rely on internal controls more, and we do a combined approach. Now, people, at the financial statement level, we have different types of risks. Look at the risks that impact the financial statement level. Things that are pervasive, many assertions, fraud, control environment. These are not your typical risks that are going to influence necessarily an accounts receivable balance. These are risks at the financial statement. They're broader risks. When you want to get down to specific balances, that's when you get to, the assertion level. At the assertion level, we'll talk about afterwards, things like, I don't know, valuation, presentation, whatever, the different assertions, existence, ownership, completeness. Okay? And we'll look at the assertions later tonight. So everything the auditor does is either at the assertion level or at the financial statement level. Now, what we do is we look at our risks and we see if the risk is significant. That's an important word because we're going to be defining our procedures around significant risks. Now, what are significant risks? So you look at this list. I'm not so worried about A, like we're going to have fraud in every case, probably not. But you know what? Complex transactions, a lot of transactions are complex. A large degree of subjectivity, a lot of transactions have a large degree of subjectivity. What's the point? The point is the bar is very low for significant risks. That is the point. Is it important? Yeah, it's important because we design our procedures to address these significant risks. But it's not a high bar to be significant. That's the point. Okay? Now, do I always look at the internal controls? Well, I get an understanding of the internal controls, but I don't always sit there and waste a lot of time testing them. Okay? Why not? Well, I don't know if they're going to be reliable. I don't know if I need to test them. All right. People, here's the point. There has been a bit of a shift over the years in how we deal with internal controls. They have taken on a much more important level of understanding. We're now at the stage where, look at that first point, we never used to say this. What the handbook specifically says is get an understanding of the internal controls. If it's not possible to get enough evidence from substantive procedures, that point would never have been made years ago. It would have always been, if the internal controls are good, you can save time, fine, then go do the internal controls. But we're now at the stage where we say, you may not be able to get enough understanding without relying on the internal controls. A very different way of looking at the internal controls. Okay, so just for some material statement, okay, nothing here. If internal controls are ineffective, again, nothing here. At the assertion level, okay, fine. Now, these three terms come up all over the place in the handbook, that the auditor should always consider three things. The nature. What's the nature? The nature of the procedure is the purpose, the type of the procedure. That's what they mean by the nature. Number two, the timing. Now, people, what are my three time periods? Anyone want to tell me in a regular audit, what are my three time periods when I can do procedures? Okay, very good. I have one here. Okay, interim, year-end, and after year-end. Very good. Before year-end, at year-end, and after. Excellent. Okay, question. Which two of the three give the highest level of assurance? Before, at, after. Which two of the three give the highest level of assurance? The answer is very good, excellent. The answer is at and after. Okay, why? So the reason is because if we do something before the year end, we're now going to rely on the internal controls in the intervening period. And if the internal controls are not good, then what's the use of my procedure? All the records are going to be messed up after that. So very good. So the timing of the procedures, right? Those are the different time periods we could do our procedures. All right. And the extent, the last term here, the extent, that's the amount, that's the quantity, that's the sample size. How much am I testing a particular transaction? Okay. Everyone good? All right. Test of controls, okay, fine. Substantive levels, okay, fine. All right, what else? Nature of test of controls, documentation, okay, fine. Timing, yes, important. People, they threw this in the handbook a few years ago. I'm not convinced this has a big practical implication in real life, but for exam purposes, I think you guys definitely should know this. You are allowed to rely on last year's test of internal controls. Now, can I do that every year and not ever test internal controls again after I've tested them once? Of course not. But you can do it as long as you test the controls every third audit. Now, people, let's be careful. Every third audit does not mean every third year. An audit does not have to be a year. An audit can be less than a year, it could be half a year, right? Who said an audit has to be from Jan 1 to December 31? It doesn't have to be 12 months. So every third audit. Why do you have to do it every third audit? I don't know, because I'm not going to let you get away with this. Think about this. What this really means is you don't have to test it again. If you did 20, I don't know, you looked at 20 checks last year, you want to make sure that each check had 2 signatures, I don't have to do it again. I can take last year's test and say it worked out well, and I can throw it into this year's file. That is allowed, but there better not be changes in the internal controls. If there are, there's no way. Then you can't do it. So if everything stayed the same and it's simply 1 year later in the process, then you can get away with reliance on prior period tests. But you can only get away for a little period of time because every third audit you will have to start retesting controls. I don't know how much I'd use in real life, but again, I don't know how that's not so relevant, to be honest, for the exam purposes. I think you guys definitely, need to know that for exam purposes. All right, anything else interesting here before we get, okay, fine, so 2021, okay, quality control, all right, fine. I'm not too interested in quality control. You guys can read that. The only thing keep in mind is maybe this last point, public companies have to appoint a quality control reviewer. Okay, it's public companies, fine. All right, now, couple of interesting things. First time audit, all right. First of all, okay, let's get the basics straight. Who needs an audit? Public company, yes or no, do I have to have an audit? Correct, yes. Private company, yes or no, do I have to have an audit? Obviously, no. Why is no one saying no? People, private company does not need to have an audit. I could do review engagement, I could do nothing. Fine. What about qualified opinion? Public company, yes or no? Am I allowed to have a qualified audit opinion? Okay, probably not, okay? I think Brian is saying not necessarily, probably not. I don't know in real life, to be totally honest, I don't know in real life what happens if you end up with a qualified opinion for a public company. It's not good, okay? I mean, they probably lose their status on the stock exchange, it's the whole thing. So I think you guys should go with the assumption that no, you probably cannot qualify a public company. Private company, yes or no, am I allowed to qualify? Okay, good. Private companies, yeah, definitely. I can qualify private company. Okay. Now, let me ask you guys a question. Would there ever be a situation I'd refuse an audit? Now the answer is good. The answer is yes. Give me a reason. It's not an everyday occurrence. Why would I refuse an audit? I'll just take one or two reasons. Good, Brian, too risky. Very good. All right, let me help you guys. Ethical problems. I don't have the expertise. They're not going to pay me. Records are horrendous. I'm worried about legal liability. All of those are reasons. So people, look, it's not a typical occurrence. I once had a situation, I didn't bother giving you my background before, but I was at Ernst & Young for 10 years, and then I went out to teach like full time. Michael was at Deloitte for about 9 years, and then like we both went out at that point to start teaching full time. When I was at EY, I still remember we had this R&D company, and they had to do an audit because they got some grant of $3 million. And it was like a weird company. It was like, I don't know, the guy used to bring his dogs to work, and they made toilet paper, and they had this massive computer sitting in the middle of the office when you walked in, and the dogs would, like, I don't know, rotate around the computer the entire, this mainframe computer the entire day. So I walked in the first time now, by the way, why are they getting an audit? They're getting an audit because they got $3 million, and they got this grant. So they have to have an audit. We've never done them before. It's a new client. I walk in the first day. The guy reaches into his pocket. He pulls out a ripped piece of paper, and he says, here you go. It's some trial balance. I got 3 assets on one side, 3 liabilities on the other side, and they don't balance. I'm looking at this, and I'm going to the guy, do you have one where this side is equal to this side? He goes, oh, sorry, I gave you the wrong one. He goes into the other pocket, and he picks out another ripped piece of paper, 3 assets, 3 liabilities. This time, they actually balance. I knew we might be in trouble on this job. In fact, this job went from an audit to a review to a notice to reader. We were never issuing anything because we could not find the cash. The guy had checks being made out $30,000, $40,000 to cash, no backup. I'd ask, you know, what is this? His answer was, oh, I don't know, it was crazy. We were moving locations, you know, I mean, it's a lot of money, must have paid for something. Okay, probably he was siphoning off a bunch of the money into his personal account. We had no idea. All we knew is we couldn't find half the cash. That is an example, not auditable. And we never gave him an audit report. So I'm not telling you it's obvious. I'm just saying that, and it doesn't happen every day, but I'm just saying that auditability, not everything. People sometimes think, yeah, of course, I can audit any company. The answer is no, there's lots of reasons. I just gave you one reason with a little story why a company may not be auditable. Okay, a couple of other sections, people, before we get into the multiple choice. Agreeing the terms of an audit engagement, okay, fine. An auditor should only accept, so this is kind of new a few years ago. If there's preconditions of an auditor present and confirming an understanding, okay, fine. What are the preconditions? You guys should know this. It's easy, comes up. Okay, here are the preconditions. Good financial reporting framework, whatever. Okay, that's pretty standard. Obtain agreement, okay, fine. Now, engagement letters. Do I need an engagement letter every year for an audit? Yes or no? People, look in front of you. Right, very good. If the answer is no, you do not have to send out a new engagement letter every year. What would necessitate an engagement letter? Give me a reason when you would. Good, new ownership, heavy related party transactions, possible buyer, risk has changed, new related parties. There's lots of reasons that you might need a new engagement letter, but people are sometimes confused here and they think you do, but you don't. A regular audit, if all it is 1 year later and nothing really is new, you do not need a new engagement letter. Which brings me to an important point for the audit elective that doesn't come up, or I say, for the other exams. You have to be careful in assurance. Not everything, especially for those of you who are working and listening to this and working in public practice, not everything you do in public practice may be the rule. You might be more conservative. Some firms do it every single year, but that's not the rule. That's not what the handbook says. So just be a little careful. I've seen people get wrong multiple choice questions where they'll tell me something in real life, they'll answer in a certain direction, and it won't be the answer. So just be a little bit, okay, just be a little bit careful here. Just be a little careful with that. All right. Now, what else? There's an engagement letter. Okay, fine. Acceptance of a change in terms of engagement. Yes, but what's the key point? As long as it's reasonable. As long as it's reasonable. Look what's not reasonable. Somebody wants to change from an audit to review. Why? Because they're having problems getting sufficient evidence. That is not reasonable. Okay, so yes, change in terms of engagement. Of course, I've been recorded in an engagement letter, and yes, you can do it. It just has to be, it's a great subjective type of question because it just has to be reasonable. And if you can't agree on the change in terms, goodbye. That is a bit of a problem, people. We have to have a functioning engagement letter. And if I can't agree with the client, now we're going to have a problem. Now, what else? I'll just look at considerations. Okay, fine. Okay. Any questions on engagement letters? Everyone good? Okay, documentation. So normally I would skip documentation. I should just read it on your own. It's not a big deal. But I got a couple of points that I just want to make sure people clue into. First of all, number one, look at the level of documentation. Of course, I got the nature, timing, and extent of audit procedures, those three terms again. But in addition, you have to document what they call the identifying characteristics. What are the identifying characteristics? Look at the example. If you're doing a substantive test of invoices, tell me they were selected from the sales journal for the period of when to when, beginning with an invoice number whenever, selecting every 40th invoice. That is the level of documentation called identifying characteristics. And this you may have learned in university. I don't know if this changed or not. It may have from when you learned it, but you have to keep stuff on file for how long? 60 days from when the date of the audit report. People, what is the audit report date? Anybody remember this? What's the audit report date? That's the date when, somebody finish off my sentence. Excellent, Brian, when the statements are approved. Very good. When the statements are authorized, when the statements are approved. That is the financial statement date, and it is 60 days from at the end of that date. After that, you're not supposed to go in and start making changes to the file. I don't think in real life this is a big deal, but I have a feeling they did this because they don't want people sitting in court and then being accused of changing the file a year and a half later when they knew they were going to court. And now we have a defense. Our line of defense is don't yell at me and say that I did that. I didn't do it. I followed the rules. The rules are 60 days. After 60 days, that's it. Okay. Now, people, let me do risk and materiality. Again, stop me if you have questions. I'll do risk and materiality, and then I promise I'm going to get you into the first group of multiple choice questions. Okay, risk. Different categories of risk. Okay, fine. Audit risk. The risk, you give an opinion. I don't know, that the financial statements are materially misstated. You goof. Not good. Engagement risk. That's mainly things to do with ethical requirements. And business risk. Keep in mind, do I have to identify all business risks? Don't get tricked on that. The answer, of course, is no. Only business risks that are relevant. I don't have to identify all business risks. We always try and limit our involvement. Then you have the risk and material misstatement. This always gets tested. At the assertion level, I have inherent and control risk. Look at the inherent risk. What's the definition? Inherent risk is what? The risk of error occurring in the first place. Okay? Inherent risk is independent. It has nothing to do with you, the auditor. You walk in and the inherent risk is there. What creates inherent risk? Most of these points are obvious, except for the first one. What's the nature of the item? Let me give you two examples. Number one, the nature of the item could be the type of a product the company is dealing with. Diamonds, jewelry, inherently risky. Why? I'm worried someone is going to steal them in the middle of the night. There's a little diamond, there's $5,000. But on the other hand, if I'm selling slabs of lumber, I'm not so worried. In the middle of the night, someone's going to walk in, okay, with some massive, I don't know, truck and start taking out my slabs of lumber. The nature of the item a jewelry store would be more inherently risky just by virtue of the fact that it could easily be stolen. But it could mean another thing. Number two, the nature of the item could be the actual balance sheet or income statement item. Some are more inherently risky. Let's go through them and just make sure we agree what's inherently risky, what's typically not. I'm going on averages now. Cash, inherently risky usually, yes or no? No. Okay, I'm getting yeses. Okay, people, no. Why would cash be inherently risky? Most businesses don't operate with 20s and 50s running around. You send out a bank confirm, you confirm cash. Even if it comes back wrong, send it out again, and you're fine. Now, if you're thinking a casino, you're right, cash would be inherently risky. But for most businesses, the answer is no, they wouldn't operate in cash. But accounts receivable and inventory, that would be inherently risky. Why? Oh, you know, accounts receivable, we have an allowance for doubtful account. That's very subjective. Inventory, we have provision for obsolescence, subjective. So, people, look, that's what I mean by nature of the item, okay, to see whether or not we have inherent risk. Now, I didn't mention all of these, but these are important. What creates inherent risk? I just mentioned kind of estimates. I mentioned things like jewelry, susceptible to misappropriation. I didn't really say 3, 4, or 5, but the reality is things that are complex, unusual, create inherent risk. People, this is important. You got to know your risk and materiality, not just for the challenge exams, but also for the CFE. All right. Any questions on inherent risk? Everyone good? Control risk. The risk of the system failing to detect and prevent an error. Once again, this is independent. This has nothing to do with you. You walk in, and there's control risk. Okay? Let's go through some factors and see if they increase or decrease. Multi-locations, increase or decrease control risk. Definitely good. Increase. Definitely increase. Why would multi-locations increase the control features? Because you don't know if the internal controls will be as good from one location to the next location. So by definition, when you have multi-locations, that increases your risk. There is a second reason, but it doesn't always apply. If you're moving goods between the locations, there's more potential for double counting, for duplication. But the truth is, that second reason doesn't always apply. I could have multi-locations and not move goods between locations. Internal auditors, hopefully it reduces control risk. Hopefully I can place reliance on the internal auditors. Management's ability to provide controls, okay, fine. New versus established control system. Okay, what do you think? New versus established control system. I'm worried if we have a new system. How do I know I can rely on it until we get rid of all the kinks? So this sounds a little funny. You're going to tell me a new system increases control risk, but the new system might be better. And the answer is, give it a year. Once you know for sure the new system is better, you're right, control risk will go down. But at the beginning, I make the assumption it's a new system, control risk goes up. And similarly, another assumption is for a growing company, we kind of assume that there's going to be so many issues with growth, whether it's supplies or cash or financing, that the big issue is not going to be having the best internal control, okay, on the block. So a growing company strains the internal controls. That's the point. Okay. You can do a combined assessment. Good. We'll talk about that. We'll have some multiple choice questions. All right. Last one, people detection risk. The risk of the audit procedures failing to detect an error. This is now not independent, does not exist independent of the audit. This is the inverse of inherent and control risk. It's based on my procedures. So note the relationship. Just make sure you know the relationship between the other elements of risk. It runs exactly opposite. What affects detection risk? Let's look at the bottom. Number one, we can make mistakes, inherent limitations. And number two, not everything is disclosed. How do you do number one? How do you make a mistake in an audit procedure? Well, I'll give you one example. I was once doing an inventory count, or I was actually reviewing the file, and it was a hard inventory count. We had to send a staff member, when I was at E&Y, we had to send a staff member up to northern Quebec, middle of the winter, and it was some massive steel yard, and this guy was counting steel with 100 feet of snow on the ground. I'm reading the file back in the office, and I see something where it says obsolete inventory. And then it dawns on me, I don't remember in his inventory, count section, I don't remember him saying anything about obsolete inventory. I call him into the office and I ask him, was there obsolete inventory? Did you see it? He says, you know what? I think there was, but I don't remember seeing it. So I said, yeah, that makes sense because he didn't note it in this section of the file. So we call the client and we say to the client, was there obsolete inventory? The client says, yeah. Now the staff member starts talking. He goes, really? I don't remember seeing it. Where was it? The client says, oh, I didn't point it out to you. It was in a corner of this massive steel yard under 10 feet of snow. I didn't shovel it because it was obsolete inventory. Who cares? People, we goofed. Luckily, it wasn't a very big number, but it was really our mistake. I'm not blaming the staff member. It was a difficult inventory count. But the truth is, he forgot to ask a very basic question. Do you have obsolete inventory? The client wasn't trying to hide anything. It wasn't a contentious engagement. The client would have told him, I've obfuscated inventory. But you didn't ask the question. So in case you're wondering, how did we mess up in a procedure? You can mess up, and we had to take it to the error summary. This wasn't so big. And what does the second point mean? Not all the relevant is disclosed to the auditor. People, you could do an audit for a small company where you're balancing to the penny. Every check, every deposit, you got it all. How would you know if they sold one inventory item, put the money in their pocket, and had no entry in the accounts? You'd never know. How would you know? You'd never find it. That is why we say there is always some type of detection risk. Either we do things wrong, or not everything is potentially disclosed to us, and we just can't find it. Okay. You multiply overall audit risk, okay, fine. That's knowing the formula, okay, fine. Assurance from an audit, let me just quickly do materiality, and we'll take a break, and then, well, I won't take a break. I'm going to give you, whatchamacallit, I'm going to get you into the first set of multiple choice questions. Okay, auditor, misstatement at 2 levels, okay, fine. Okay, nothing there. All right, materiality. So people, the guidelines are very simple. I don't think people have a problem with the guidelines. If it's before income, you're talking 5 to 10%. If you're dealing with revenues, expenses, sales, you're dealing with, I don't know, somewhere between 0.5% and 2%. That's it. So the statistics should be a joke. My starting point would be income. But there's many ways to move away from income. If the company is losing money, I can't use income. They're losing money. If it's an NPO, I can't use income. Use gross revenues or expenses. If it's a specialized industry, maybe income, not the right thing to go. So all I'm saying is there's nothing wrong with income, but don't automatically assume that materiality is based on income. There's many examples where we leave income and we base materiality on another factor. Okay. Now, people, there are different levels of materiality. You don't have to have 3 levels, but you could. On the financial statements as a whole, that's the broadest. Or you can have a smaller number, class of transactions. Number 2 rarely ever gets tested. That one gets ignored. And number 3, performance materiality. That's the lowest one. And that one comes up all the time. So typically, especially in case writing, you end up with 2 materialities on the financial statements as a whole, and then performance materiality. Okay. All right. What else? Determining materiality. All right, fine. Influence influence. Consider revising. Okay, nothing new here. Okay. The big qualitative reason for materiality, what is it based on? What is it determined by? Users of the financial statements. So people, do me a favor, don't link materiality to risk. They don't like that. The truth is, over the years, we've been teaching this for many years. I'm not going to tell you they're 100% consistent. The truth is, I can find you an inconsistency here, but it's an inconsistency. Okay, it's an inconsistency, it's unusual. So go with users of the financial statements. That is the big thing that dictates materiality. All right, documentation, the statements, okay, fine. I'll get some of these in multiple choice questions, types of misstatements, nothing there, okay, fine. Okay, and the last thing, then I'll get you into a bunch of questions. The last thing is errors. I can't talk about materiality and not talk about errors. All right, what's an IM, identified misstatement? Example, I'm counting inventory, and I count 7 items, and the list has 9. That's an IM, that's an identified misstatement. Now, what I'm going to do is I'm going to project that error, because I'm not counting every single item. I'm only doing a sample. If I found 1 error, there could be more. So I will project it over the population. That's called a likely misstatement. I'll add up number 1 and number 2. I'll get a likely aggregate misstatement. Number 4, the client says the allowance for doubtful account is $5,000. I say to the client, no, I don't think so. I think it's 10, maybe even 15. The client says, no, I don't think so. I think it's 5. I say, no, I don't think so. I think it's 5. I think it's 10 to 15. We have a disagreement. If I think the client is wrong and outside of my range, I think it should be minimum 10, and the client is saying 5. I will take 5,000 to the error summary. That is called a further possible misstatement. I'm not going to project it. I'm not going to say because I have one argument with the client, I'm going to have multiple arguments. I don't project my arguments. But I'm going to say, no, 5,000 goes to the error summary. And the total is number 3 and number 4. That is the maximum possible misstatement. Any questions? All right. Last thing, as part of materiality. Okay, well, I'm going to give you 3 situations. And I want to say one thing before I give them to you because it's going to apply to the multiple choice questions. Some of the multiple choice questions are just going to be technical multiple choice, either you know them or don't. But other multiple choice questions can be more subjective. That is very typical of assurance. It's one of the reasons people don't like multiple choice questions in assurance. They just tend to be more subjective as opposed to things like tax or financial accounting. By subjective, I mean they give you a scenario, a situation, and they ask you, what do you do? What happens here? What's the next step? So look at these situations. What happens if my IM, my identified misstatement, and my LM, my likely misstatement, are below materiality, but the LM is close? Well, people, if I was thinking really logically, I probably would get this wrong. Because I'd say, do nothing. You have not breached materiality. Your likely is close, but you haven't breached it. We are so conservative. We say you would come to lower them, try to lower them. They don't define close. Now, that to me was the non-obvious one. The other 2 are obvious. If the IM is less, but then when you add it up with the likely, you're above materiality, you have a problem. Obviously, you're going to have to lower something in order to give an unqualified opinion. And number 3, which is also obvious, if both the IM and the LAM are above materiality, obviously they both need to be reduced significantly. Okay. Questions? All right. Any questions? Okay. People, let me give you, and I don't even mind writing it down. I will write down and tell you which multiple choice questions I want you to do. Okay? Can you do the following? Can you do question A, 1, 3, 6, 7, 8, 10, 11, 13, 14, 17, 18, 19, 20, 23. Oops, I put 17 twice. 14, 17. No. Anyway, okay, sorry guys. Anyway, we should look what I'm doing. 17, 18, 19, 20, 23. Okay. All right. People, that's your list of questions. I'd like you guys to work on these, okay? It doesn't take that long to do them. I'm giving you, I'm going to count here how many I'm giving you. But the truth is, these first questions are going to go very quickly. I will stop the recording now, okay? But I'd like you guys to work on these. I'll give you about 10 to 15 minutes, however, whatever you need here. I have about 7:38. So, I don't know, go to 7:50, let's say, and we'll see if you're finished. If you're finished, fine. If you need a few more minutes, that's also fine. Okay? See if you can do these questions. And not every single one is going to be something I did with you. I'm trying to teach from the questions also, so don't worry about that if you see something that we didn't exactly cover. See if you can do these questions, and then we'll go through them. Okay? Take that about 12 minutes. tape. So this concludes the beginning up until like materiality. Actually, you know what? Maybe I'll continue this recording, and we'll look at the multiple choice questions. Okay, people, let's do the multiple choice questions. So, all right, let's take them up, and then what we'll do is then we'll take a break. Maybe we'll do a second recording for the next one. Okay, so now, by the way, the reason I only asked you to do like some of them is just because, again, of time. There's just too many multiple choice questions. One of the nice things of auditing is I can get through a lot more multiple choice questions than I can in financial accounting. But even though I'm still limited, obviously. So the ones I'm not doing, people should just practice on, you know, when you're studying. It just gives you some more questions to do. Okay, so someone can just read out the, just jot down the answer, and then I'll explain ones I think I need to explain. All right, so A, CES apply to which of the following? Answer is good. The answer is D. It applies to all of them. Right, very good. This isn't like, again, as I said at the beginning, this isn't like ASPE and IFRS where we have different, like, you know, users and stuff, different markets. We're talking for CES applies to everything. Number one, which of the following is not correct? Answer is number one. C. Right, very good. Materiality to be computed on the basis of net income, not necessarily. There's other reasons, right? Like I said to you, it could be a loss company, it could be an NPO. So there's other reasons. You don't always do it on basis of net income, so C is not correct. Number three, which of the following is most correct? Answer is good. D. Very good. The answer is D. Okay, for number three. All you have to see is someone who says they are charged with governance. Whoever's charged with governance, they're the ones that are going to be, you know, dealing with the terms of engagement. It could be management, but it doesn't have to be management. I don't want to be pigeonholed into management. Okay. Number six. Which one's not normally part of preliminary engagement planning? Answer is number six, B. Answer is B for number six. The hint is in the first word. The hint is in the first word because it says the assessment. Assessment, I'm not in the position to assess in the planning stage. I'm in the position to assess after I've done the work. That's why that is not normally part of planning. All the others are. Number seven, which one is most correct? The answer is, I kind of said this when we were in the lecture. Number seven, answer is good. C, very good. Okay, 60 days. Number eight, I have this in the notes, but I didn't bother saying it. Which one is most correct? Answer is D, okay, for number eight. It's actually 5 years, it's not 7 years. It's actually 5 years, okay? A lot of people sometimes think it's C, it's actually D, it's 5 years. Number 10. Bit of a hard one. Which one will have the least impact? Now, I'm going to give you two ways to get number 10. The answer is B. The answer is B. Now, here's the thing. Number one, sometimes there's a hint in the multiple choice question. You'll see a commonality among a whole bunch of different choices. This is like the Sesame Street game. Which one is different? Which one is not like the others? You notice a similarity between A, B, and D. A dealing with the junior, not B, sorry, A, C, and D. A dealing with the junior, experienced staff in C, and the audit team in D. So all of A, C, and D are dealing with staffing. B is different. It's talking about the number of locations. That's your first hint. But that's not good enough. So why is B the least impact? Very simple. The number of locations affect the control risk, which affect the overall risk, which affects the financial statement level. That is most removed. Staffing affects the financial statement level. It's much closer. I'm not saying that the control risk, the number of locations, don't impact it at all. I'm just saying that has the least impact if you're dealing with the risk material statement at the financial statement level. That's the only reason. Everyone get that? Stop me if you have any questions. Okay, number 11. Which one is most correct concerning materiality? Answer is, this was in the notes, I didn't say it, so some of these again I purposely teach in the multiple choice. Answer is number 11. Answer is B. Answer is B. People, what's a trivial error? Obviously it's immaterial, but it's unbelievably low. They don't define it exactly in the handbook, but a trivial error, I don't know, $52.35. Let's say materiality is $25,000. Is a $2,000 error material? Of course. Would that be trivial? No. Not that many $2,000 errors. Can they start adding up? I'm in trouble. But you get into like 50 bucks, that's a trivial error. So you have to use your judgment, and you don't have to summarize them. Okay, number 13. Answer is D. Good. Answer is D. People, again, you could have used the Sesame Street game. All the others, A, B, and C, are dealing with, you're doing work on the client, records, people, whatever. D, you're doing among the engagement team. That's kind of an internal thing. I'm not saying it's not important, but that is not what we would consider to be a typical risk assessment procedure. Number 14. Again, stop me if you have any questions. Which of the following is not correct? Anyone get 14? Answer is B. Look, we are supposed to go in with a clean slate. We are not supposed to go in assuming the client is telling the truth. That may sound funny to people, but it's true. We do not have an assumption of management good faith. Probably because they don't want auditors to be accused in court a year and a half later of missing a fraud because they went in assuming management told the truth when they didn't. Not that it really is our job, and we have a million line of defenses against us, but it's still, they don't want that principle there. We go in, it's a clean slate. I don't know if it's true or not. I have to go and do my work. Okay, that was 14. Now, people, 17. Some of these are actually old UFI questions. The UFI at one point in history actually had multiple choice questions. And they were public. So I kind of took a few of these. It's about 5 years in a row they had multiple choice questions. Number 17, which of the following does not impact inherent risk? Was an actual UFI question. Well, 2/3 of the country got it right. I didn't think it was such a hard question, but I'm not sure why more people didn't get it. Answer is 17. Answer is D. Very good. The answer is D. Yeah. Again, that's different. Use of the financial statement. That affects materiality. That does not impact inherent risk. 18. Another UFI one. Which one most appropriate for this year's audit? Half the country got it wrong. All right. Don't get misled by the percentages. The answer in 18 is B. The reason it's B. Forget the percentages. They're all about right. 1, 1.5%, 2%, they're fine. It's an NPO. It cannot be income. What's the one thing you know for an NPO that you have to control if you don't know anything else about an NPO? Expenses. That's why the answer is B. Could it also be revenues? Could it also be C or D? Yes, but I have to know how they're earning their revenue. If they get a grant every year, then the fact is revenue could be good, nice and stable and predictable. But if they earn their money from donations going door to door, forget revenues. It could be all over the place. This question purposely didn't tell you any information. They just told you the name of the NPO, Protect the Wildlife. And then they gave you a bunch of statistics. That was not enough. Absent any other information, you have to go with expenses. That's why the answer is B. Okay, 19. Another easy question, half the country got it wrong. No way people will get this wrong, but it's a very important question, and it shows a problem that people sometimes have with these multiple choice questions. People, what's the answer for 19? Okay, I'll even help you. Can we eliminate, okay, everybody tell me if you agree with me, but can we eliminate A and C? I'm hoping everyone's going to say yes, because what the heck do confirmations have to do with inherent or control risk? Confirmations are a procedure, so it has to do something with detection risk. So it's either going to be B or D. I'm narrowing it down for you. What's the answer for 19? B or D? Good. The answer is B. Excellent. People, look, I bet you a lot of people said D. One of the things people sometimes do in these questions is they read into the questions. What happens in real life if the confirmation return rate is lower than you want? You would do another procedure and risk would not be impacted. That's what happened in real life, and the answer would be D. But we just invented a new question. That's not what the question says. The question says the confirmation return rate is lower. How was audit risk affected? It goes up. That's the answer. Don't read something into the question. Don't go the next step. You want to create your own question? Have fun, create your own question. But just read the question. That's all it said. So the answer is B. You want to go do another procedure? Good, we can get it down to D. But that's not the question. So the answer is simply B. Okay, don't read something into the questions is the key point. All right, finish this off. Number 20. Which of the following is correct? The answer is D. Both are wrong. A new engagement letter is not needed this year. Incorrect. Why do I need a new engagement letter? Because ownership has changed. Number 2, all partners have to sign, including retired partners? No way. No way. A retired partner, why does he not have to sign or she not have to sign? She leaves 15 days before year end. Doesn't have to sign? That's right. Because you know what she can say? How do I know what happened after I walked out the door? I don't know what happened. You're talking about the rep letter. I don't know what happened to all the assets and the liabilities. I left. Yeah, sure, I was there 11 and a half months. But the second I walked out the door, maybe they sold all the assets. What do I know? So the retired partner's gone. And what about a new partner that comes in 2 days after the year end starts? Too bad. They're now, or sorry, not 2 days after year end. What about a new partner that comes in 2 weeks before year end? Too bad. They're on the hook. Oh, but they weren't there the whole year. Okay, but they're there at the end of the year. Don't confuse this with legal liability. I am sure a partner could be sued if they're there 11 and a half months and then they leave. Don't confuse this with legal liability. We're simply talking about signing off on the rep letter. We don't hunt down retired partners. They're gone. Leave them alone. So the answer is D. Both 1 and 2 are incorrect. If you want the last one, which I won't even get into so much now, let's just get the answer and then I'll explain it after the break. Which of the following, you'll see why in the lecture, which of the following statements is not correct? The answer is, anyone get this? It's a hard one. The answer actually is A. The answer is A. there is a situation where you can use negative confirms as your sole form of evidence. Negative confirms. What's a negative confirm? A negative confirm, send it out and you say, don't return it unless it's wrong. It's a very low level assurance because you don't even know if it got to the user. You don't even know if they opened up the mail. You hope it doesn't come back. That's a negative confirm. A positive confirm is when you send out a confirm and they return it, either with or without the balance. I don't know. Positive, it doesn't really matter, whatever, whichever way you want to do it. So how can a negative confirm give me enough assurance? There is a situation, it'll come up afterwards in your notes. But that's the reason the answer is A. It's not correct to say you should not use it as the sole source of substantive audit procedure, because you could use it as the sole source of substantive audit procedure. Okay, people, any questions? That really concludes the first part, okay, the first tape. So, okay, I'm going to stop the tape over here. Let's take a 10-minute break. I have about, whatever it is, I have 10 after 8. Why don't we go till 8:20? Okay, take 10 minutes, and then we'll continue. Okay? All right.